Part 1. The mindset of an investor. Do you know the biggest mistake most people make with money? They save but never invest. While your money sits in the bank losing value, the wealthy are multiplying theirs through investments. The truth is, you don't need millions to start. Even $10 can put you on the path to wealth. In this video teaching guide, I will show you step by step how to start investing right now, even if you are a complete beginner. Let's begin with the mindset of an investor. Every great investor starts with a vision. You need to understand that investing is not about getting rich overnight. It is about building wealth steadily over time. Think of investing as planting seeds. You don't eat the fruit the next day, but if you keep watering the seed, it grows into a tree that produces for years. One of the biggest secrets of the rich is that they let their money work for them. Instead of working endlessly for money, they build systems where their money grows while they sleep. This is the power of investing. Now, let's talk about compound interest. Albert Einstein once called it the eighth wonder of the world. Compound interest means your money earns interest, and then that interest also earns interest. Over time, this creates exponential growth. Imagine you invest $100 and it grows by 10% in a year. You now have $110. Next year, that 110 grows again by 10%, and now you have 121. Over decades, this effect becomes massive. Here's the truth: saving money alone won't make you wealthy. Inflation slowly eats away at your savings. If you keep your money under your mattress or in a regular savings account, you are losing value every year. That is why investing is not optional. It is essential. But I know what you might be thinking. What if I lose money? What if the market crashes? These fears are normal, but the key is understanding risk and time. In the short term, investments can go up and down. But in the long term, markets have historically grown. Those who stay patient and consistent come out ahead. Another mindset shift is seeing money as a tool, not just as cash to spend. Every dollar you spend on unnecessary things is a dollar that could have been invested to grow. When you start thinking of money as seeds for your future, your choices begin to change. To summarize this section, investing is about planting seeds and letting them grow. Compound interest is your best friend. Saving alone is not enough. Patience and consistency matter more than luck. Money is a tool, not just for spending, but for creating wealth. With this mindset, you are ready to understand the different types of investments. In the next section, we will explore the investment options available and how they work, even for beginners. Part 2. Understanding investment options. Now that you have the mindset of an investor, let's explore the different types of investments. Think of investments as vehicles. Each one can take you to your destination of wealth, but they move at different speeds, have different risks, and require different levels of attention. The first and most common type is stocks. When you buy a stock, you are buying a small piece of a company. If the company grows and makes profit, the value of your stock increases. Stocks can be risky in the short term because prices go up and down daily, but in the long term, they have historically given strong returns. Next, we have bonds. Bonds are like loans you give to governments or companies. In return, they promise to pay you back with interest. Bonds are safer than stocks but usually provide lower returns. They are great for stability. Mutual funds are another option. These are collections of stocks and bonds managed by professionals. Instead of picking individual companies yourself, you invest in the fund, and the manager does the work. However, they often charge fees, which can eat into your profits. Exchange-traded funds, or ETFs, are similar to mutual funds but often cheaper and more flexible. Many investors prefer ETFs because they are easy to buy and sell, and they provide instant diversification. For beginners, ETFs are a powerful way to get started. Real estate is another major form of investment. Buying property allows you to earn rental income and benefit from rising property values. While real estate often requires more money upfront, today there are new ways to invest with small amounts through real estate investment trusts, also called REITs. And of course, in today's world, there is cryptocurrency. Digital currencies like Bitcoin and Ethereum have created millionaires, but they are also highly volatile. If you choose to invest in crypto, only use a small portion of your money and treat it as a high-risk, high-reward bet. To help you decide, here's a simple breakdown. Stocks: higher growth potential, higher risk. Bonds: safer but slower growth. Mutual funds: managed investments but higher fees. ETFs: diversified, Low cost, great for beginners. Real estate, tangible assets, long-term wealth builder. Crypto, speculative, high risk, only invest what you can afford to lose. The key to smart investing is diversification. That means spreading your money across different types of investments so you are not putting all your eggs in one basket. When one investment goes down, another may go up, balancing your overall portfolio. In the next section, we will look at how to start investing with very little money and how you can build a strong foundation even if you feel you don't have enough to begin. Part 3. How to start with little money. Many people believe you need thousands of dollars to start investing. That is not true. Today, thanks to technology, you can begin with as little as $10. The most important thing is to start, no matter how small. The first step is to choose an investment platform. Depending on where you live, there are apps and websites that allow you to buy stocks, ETFs, and even fractional shares. A fractional share means you don't need to buy a whole share of a company like Apple or Amazon. You can invest with just a few dollars and own a piece of that stock. The next step is to set up automatic contributions. Instead of waiting until you feel ready, commit to investing a small amount regularly, such as $10 or $20 a week. This habit is called dollar cost averaging. It means you buy investments consistently, whether the price is high or low. Over time, this strategy smooths out market ups and downs and reduces your risk. You also need to set clear goals. Ask yourself, what am I investing for? Is it retirement, buying a house, starting a business, or financial freedom? Your goals determine how aggressive or conservative your investments should be. For example, if you are young and have 30 years until retirement, you can afford to take more risk because you have time to recover from market drops. But if you are close to retirement, you may want safer investments to protect your money. Another tip for starting small is to focus on low-cost index funds or ETFs. Instead of trying to pick the next winning stock, these funds allow you to own hundreds of companies at once. History shows that over time, the market as a whole tends to rise, so by owning the market, you benefit from that growth. Also, remember to reinvest your dividends. Many stocks and funds pay dividends, which are small payments to investors. If you reinvest those dividends instead of spending them, your money grows faster thanks to compound interest. Let me share a powerful example. Imagine you invest $100 every month for 30 years in an index fund that grows at an average of 8% per year. At the end of 30 years, you won't just have the $36,000 you invested. Your money will have grown to more than $150,000. That's the power of starting small and staying consistent. In the next section, we will look at common mistakes beginners make and how you can avoid them to protect your investments. Part 4. Avoiding beginner mistakes. Now that you know how to start, it's important to avoid the mistakes that cause many beginners to lose money. The first mistake is investing without education. Never put your money into something you don't understand. Take time to learn the basics before you invest. The second mistake is trying to time the market. Many people try to buy when prices are low and sell when prices are high. The problem is, no one can consistently predict the market. Even professionals get it wrong. Instead of timing the market, focus on time in the market, staying invested for the long term. The third mistake is emotional investing. When prices drop, many people panic and sell. When prices rise, they buy out of fear of missing out. This buy high, sell low pattern is the fastest way to lose money. Stay calm, stick to your plan, and remember that markets go up and down naturally. The fourth mistake is not diversifying. If all your money is in one stock or one type of investment, you are at higher risk. Spread your investments across different areas to reduce risk. Another mistake is chasing hype. When you hear people talking about the next hot stock or cryptocurrency, be careful. Often, by the time everyone is talking about it, the opportunity has already passed. Do your own research and don't follow the crowd blindly. Finally, don't ignore fees. Some investment platforms and funds charge high fees that slowly eat away at your returns. Always check the cost of investing and choose low-cost options whenever possible. By avoiding these mistakes, you protect your money and set yourself up for long-term success. In the final section, we will put everything together into a long-term wealth building strategy. Part 5. Building a long-term wealth strategy. Now let's bring everything together and create a strategy for building wealth. Step 1 is to define your financial goals. Do you want to retire early, buy a house, travel the world, or simply achieve financial freedom? Write your goals down and be specific. Step 2 is to build an emergency fund before investing heavily. An emergency fund of 3 to 6 months' expenses protects you from unexpected events like job loss or medical bills. This way, you won't be forced to sell your investments during tough times. Step 3 is to create a diversified portfolio. This means owning a mix of stocks, bonds, real estate, and maybe even a small amount of crypto. Diversification reduces risk and helps your money grow steadily. Step 4 is consistency. The best investors don't invest once and stop. They invest regularly for years. Whether it's $10 a week or $1,000 a month, consistency is what builds wealth. Step 5 is patience. Building wealth takes time. Don't expect overnight results. Remember, investing is like growing a tree. The longer you let it grow, the more it produces. Step 6 is to keep learning. The financial world is always changing. Keep reading, watching, and listening to financial education. The more you know, the better decisions you will make. Finally, step 7 is to enjoy the journey. Investing is not just about numbers. It's about creating a life of freedom and opportunities for yourself and your family. Imagine this. 10 years from now, you look back and realize that the small decisions you made today, starting with just $10, staying consistent, avoiding mistakes, and being patient, have built a foundation of wealth and security. That is the power of investing. So, don't wait for the perfect time. The best time to start investing was yesterday. The next best time is today. Take action now. Your future self will thank you. Please don't ignore the subscription button and put on the notification bell because a lot shall be posted.